I've pointed this out before, and it's not to make a projection of a target. If you go back and look at the 1976 corrective low in gold, which is around 100, it had been up to 275. Pull back to 1976 to about 100. It went up to $850 3.5 years later, an eightfold move. In the year 2000, 2001, gold was basing just above 250. Okay, never got quite to 250, but repeatedly tried. Stock market was topping then, by the way, in 2000. Gold was bottoming. Okay, stock market topped, went down through 2002. Gold started its bull trend. It lasted until 2011. But by the time it got to its 2011 peak, it had another eightfold move. You can see this on a logarithmic scale chart, where the move in 1980 and the move to 2011 were both the same scale when you think of a logarithmic scale. Or ratio gain. Okay, if we do a ratio gain like that, we'll be at $8,000 plus because our bear market low was 1,050. Okay, we've only had a fourfold, not even that. Excuse me, a 3.4 fold. Okay. We're 3,400. We're 1,050. Okay, we're not even halfway to the ratio gains seen during those prior two bull markets of the last 50 years. Now, in those environments that gold was in then, were hardly as catastrophic and is monetarily likely to be stimulated by central banks across the globe to try to put the fire out. So once they come in to put the fire out, that's when gold goes really berserk. And it's only just begun. Again, look at the T-bond market, look at the dollar index breaking, look at the stock market breaking, and look at the data points that will follow. The central banks they've only woken up. They've hardly pushed the throttle. And when they do, gold will go berserk. It did in both those occasions. Only this time, the factors are far more explosive. And the alternatives in those two times were also T-bonds. If you go back and look at bear markets in the stock market, like 2000, 2002, or 2007 to 9, for example, T-bonds played pretty good then. You could have bought gold or T-bonds. They both worked out pretty good. Gold was ultimately better, but they worked. They were an alternative. They're not an alternative this time. Where do you go? You can't buy T-bonds. They're very dangerous looking. So all of a sudden, if you're looking to move money, billions of dollars out of your managed asset fund, asset manager, he's not even a gold bug, but he looks around and says, geez, it's the only place that's behaving. And when that money flows, it no longer goes in T-bonds and gold, it goes into gold. Silver, gold miners, and that's what I expect to see. But the full throttle event hasn't even happened yet. And that's going to happen when that stock market blows that 4,800. The data points really go dark. T-bond crisis is suddenly not manageable. Already it's not really manageable. And the central banks have to really panic, et cetera, et cetera. So all these things are working in gold's favor, but they haven't even hit the max point. Now, what's interesting is silver's behavior over the last 5-6 months has not matched gold's. Gold makes a high, pulls back, and takes it out. Silver made a high back in October above 33. You can see on the top chart, the price chart, the weekly price chart. And it pulled back hard. And then came up to 35 in October of last year and had another drop. And then again, 4 weeks ago, made a high at 35 again. So it went back up to the old high above 35, didn't go to 36. And collapsed with what? With the stock market break that occurred April 3rd, 4th, and on the opening of April 7th. A 2.5-day collapse in the stock market. Silver joined in. So did the commodity complex, by the way. Bloomberg Commodity Index, crude oil puked big time. Copper dropped pretty hard. So all commodities broke. Now, people think, therefore, by the way they treated silver in that break, that silver is just an industrial metal. And they mentally divorced it from gold, which is a mistake, because if you go back over history, they don't break apart. Silver follows gold ultimately, and often leads it. Okay, but you had this huge puke in silver, and you only had 3 or 4% drop in gold, hardly a drop, and yet silver dropped 35 to 27.5 bucks in a matter of days. Incredible wipeout, end of the world. Okay, then suddenly within we're now up to 33 again. Okay, either side of that, last week's high, this week's high. What that momentum chart below shows, instead of an upward channel that gold's been stuck in, since last May, that momentum chart made a high and has created a downtrend channel. Now, if that chart on the bottom were a price chart and you were a technician, you would draw the line we drew on that bottom chart, the momentum chart. We plotted it through 3 peak weekly closes. It's a downtrend, meaning if you now assert yourself and get back above that red line on that bottom chart, forget that it's momentum, pretend it's a price chart. you're breaking out. You've got a fresh buy signal. Well, what momentum is telling you is if you get back up in the high 34s again, we've been 33.20, I think, last week and this week. You go another buck and a half, $2, get up to high 34s. So you have to get to 35 again. That's going to be breaking out, in which case it's saying, hey, that was a bear trap in silver. People made a mistake thinking silver must go down with the stock market. It's suddenly rejoining gold and is about to explode because you go through the top of that channel. That is a major momentum buy signal. And by the way, another note, whenever we can define three waves on momentum, down or up, clear waves, where there's no subjectivity to it. Clearly, there are three waves here since that peak back in May of last year on momentum. Three waves down, that's all you get, and you've got a channel defined as well. So you've got two factors to employ there. You get up to the top of that channel again, so I'm telling you, if you're not in silver and you see it get back up to 34.90 or especially touch 35 again, assume it's going to launch big time. And I bet at that point, when that occurs, and we think it's going to occur, at that point, silver will launch versus gold. And so silver's relative pricing to gold, which is very cheap right now, historically very low. 1% of the price of gold. It's done that a few times before. And whenever it does, it slingshots, by the way. At that point, that's when silver says, me too. And I think that's about to happen.
People keep asking, is this it? Is this the breakout? And I tell them, you're asking the wrong question. You should be asking, what's the signal telling us? Because the signals don't lie. They didn't lie in 1976. They didn't lie in 2001. And they're not lying now. The key is to stop watching price in a vacuum and start watching what price is doing relative to time and structure. That's momentum. Let's go back a bit. In 1976, gold had already made its first run to $275. People thought that was it. It corrected all the way back to $100. And the entire investment world, they walked away. They said, see? That was the top. But what they didn't understand was that $100 wasn't a failure. It was a base. Momentum was forming a new foundation. What happened next? Gold rallied from $100 to $850 in 3.5 years. That's an 8-fold move, and not because of price headlines, because of structural shifts in the global system. Fast forward to 2001. Dot-com bubble burst. Gold had been bottoming for years, basing just above $250. Meanwhile, the S&P was topping. T-bonds were still an option back then. You had alternatives. But guess what? Gold started a new bull run. Same thing, another 8-fold move. From under $300 to over $1,900 by 2011. And again, it wasn't just about inflation. It was about perception of risk and monetary response. Central banks started printing in a coordinated fashion after the 2008 crisis, and that lit the fire. And here we are in 2025. Let's talk about what the signals are saying. We bottomed at $450 in the early 2000s. We're now at $3,400. That's a 3.4x move, not even halfway to the ratio gains of prior bull markets. And yet the backdrop is more explosive than anything we've seen in 50 years. In the past, when gold surged, you still had T-bonds to fall back on. In 2000 and 2008, T-bonds offered cover. You could park capital in sovereign debt and still sleep at night. Not anymore. The T-bond market is breaking, technically, structurally, and psychologically. And here's what's different this time. There is no alternative. There is no safe haven in fiat instruments. Sovereign debt is a risk, not a hedge. And if you're an asset manager sitting on billions and you see gold behaving like a real market while everything else is unraveling, what do? You rotate. You reweight. You stop pretending fiat is real. And when the flood of capital comes, and it will, it won't be like 2008 or 2011. It'll be pure verticality because there's nowhere else to go. Now let's get into silver. Silver has underperformed gold for months. That's true. Gold has been setting highs, pulling back modestly, and taking them out again. Silver? Not quite. We saw a high above $35 back in October, pulled back hard, came back up, tapped $35 again just a few weeks ago, and then dropped like a stone with the April 3rd to 7th stock market collapse. Total puke. Now here's what's fascinating. Gold dropped maybe 3 or 4%, barely a scratch. But silver from $35 to $27, a $7 crash in a few days, and everyone panicked. Social media melted down. Silver's dead. It's an industrial metal again. Wrong. Let me tell you what the momentum is saying. Silver is not failing. Silver is coiling. That puke out was a bear trap, a washout, and now we're already back to $33. That's strength. And more importantly, we're approaching a technical moment of momentum breakout that few people are talking about. If you look at the weekly momentum chart, not the price chart, but momentum, you'll see a downtrend channel forming since the May 2023 high. We've drawn the line through 3 clean weekly peak closes. This is classic technical behavior. You form a slope. It defines the battle lines. And when price reclaims the top of that slope, momentum signals buy. It doesn't ask, it tells. We came close last week, $33.20. Again this week, a buck or two higher? That breaks the downtrend. That gives us confirmation that silver's correction is over and the new leg is beginning. And the context is critical. This isn't just a random move. This is happening while gold is consolidating near all-time highs, while the stock market is flashing red, and while commodities like copper and oil are still trying to find direction. Silver has been the laggard, but laggards become leaders when they cross momentum thresholds. Remember, in every past bull cycle, silver explodes after lagging. It doesn't go step for step with gold. It waits, it builds energy, and then it outpaces everything. You know, people like to talk about fundamentals, supply, demand, solar panels, EVs. That's fine, but that's not what drives the launch. What drives the launch is when the psychological threshold breaks, when money sees that silver is no longer under control, when price action flips from expected to unthinkable. That's when the bid chases itself. So if you're sitting there waiting for 24 silver to get in, good luck. Because when this next momentum trigger hits, you'll blink and it'll be $38, $42, $50. And you'll be the one saying, I'll wait for the pullback, as silver prints new weekly highs like clockwork. There's another piece here that matters, a lot. And that's the relative momentum between gold and silver. Right now, silver is about 1% the price of gold. That's historically cheap. The gold-silver ratio is still over 100 to 1. That ratio has only been this extreme a handful of times, and every time silver slingshotted. Not gently, violently. And when silver outperforms gold in a bull market, it does so explosively. That's when you see 2x, 3x, even 4x moves in months. And the setups are there. We've got a 3-wave correction visible on the weekly momentum chart. That's a classic Elliott bottoming structure. Add in the downtrend line we're about to breach and the structural case is airtight. This is not a time to be timid. This is the time when generational trades are formed, not in price, but in behavior. And when markets shift from passive to aggressive, the door slams shut fast. I'm going to walk you through what happens next in part 2, where we look at what happens when momentum meets institutional flow, how gold miners are lagging and about to catch up, and what kind of timeline could deliver the next parabolic move in both metals. We'll also dive into why the stock market breakdown at the 4,800 level is going to be the domino that triggers a sovereign bond crisis, and why central banks, who are barely awake right now, will soon hit the full panic button, just like they did in 2008 and 2020. Only this time, there's no bond rotation escape route. This time, it's gold, silver, and miners. That's it.
What do you think Jay Powell does? You mentioned earlier he's already
it could be
that
that argument there could be a delaying factor for Powell, because he's got to have justification other than simply Trump said to cut rates. He's got to have some bad numbers. That means he's got to literally wait for some horrible data points, unemployment numbers, all kinds of other data points they look at. They need to have some dark numbers. And so they can say, our other mandate is in play now, the economy and unemployment. Otherwise, he's given in to Trump. So that means if he might have done it earlier otherwise, he's not going to do that. So he will definitely delay. That's fine. It doesn't matter. We showed charts of 2000, 2002 S&P and 7 to 2009, the S&P, and put arrows on the charts all the way down. Arrows were the Fed cut, Fed cut, Fed cut, Fed cut, Fed cut. It didn't mean anything. It meant something to gold. It didn't rescue the stock market, because once those bubbles break, the bubble takes over. The central bank is merely a road bump in the process of liquidating the bubble. And we right now have the biggest stock market bubble in U.S. history, both in duration of time, time spent, and percentage gains. So welcome to the party. I have no idea. I don't predict the Fed. I just know that historically, when you go back and do your homework, it doesn't matter. When they start cutting rates after a period of pause, they may raise rates for a couple of years, then they pause. And when they start cutting, the market starts down or have already started down, and it doesn't help the market historically.
In other words, it's too little too late. They're way behind the curve.
The fire started. You're not going to put it out with a tiny hose. They'll have to go to QEs, and those won't work either. Even when they did, if you go back and look, we did a study of this because everybody has this burnt in their memory. Oh, if the stock market goes down big, gold will go down. There's 1 month that's got everybody concerned, and that was October of 2008. The S&P dropped 30% that month, meaning a crash event. But that was already a full year off the high. It had been going down hard for a total year. And then finally, a month after Lehman went under in September 2008, the S&P puked 30 some odd percent. That's when Bernanke came in, took the little Japanese trading book, QE, and deployed it. And in November, 2 months after Lehman went under, and a month after the stock market puked, already a year into a bear trend, he finally did QEs because rate cuts hadn't been working. And you know what happened in November? Stock market went down hard again, and it kept going down till March of the next year. 30% more drop, even after he did QEs. What happened to gold? In October, it did have a sell-off. It was a corrective, brief sell-off in August, September, especially October, where it needed to correct. It had a huge move at that point. Even while the first year of the stock market had been going down, gold's still going up. It was only in that later part of 2008 that finally the stock market had a puke that gold said, oh, I need to correct anyway, and it had a very bad month. But when they did QE, stock market went down another 30%. Gold exploded in November when they did the QE and was back to its highs by early 2009, on its way to 1900. So again, what the Fed does, don't count on it helping the stock. In fact, when they start cutting rates, panic, because they're admitting, okay, that's when they scream. Okay, so they're late to the game. But when they start doing what the head of the Boston Fed, the woman who's head of that, spoke Friday a week ago and said, we've got various tools to employ if things start to happen like that. And she meant not just rate cuts, like QEs. So that was an admission. It was quite revealing.
So where do we go from here? Let's revisit what happened in both 1980 and 2011. In both cases, the big vertical moves in gold and silver occurred not at the beginning of the trend, but near the end, when momentum boiled over and capital had no exit but precious metals. The move from $400 to $850 in 1979 to 1980 didn't take 5 years. It took 9 months. The move from $1,000 to $1,900 in 2010 to 2011. That took less than 18 months. So when people say gold is overbought at $3,400 or silver looks frothy at $33, they're just admitting they've never seen a real monetary revaluation. This is not about being early or late anymore. It's about understanding flow. And flow is changing, fast. We've tracked this through the momentum channels. When silver broke below $28, we warned it wasn't the end. It was a shakeout. The momentum trend line on the weekly chart is clear. It shows 3 distinct waves down from the May 2023 high, culminating in a puke that most people mistook as fundamental weakness. It wasn't. It was an engineered reallocation. You see, this wasn't just retail weakness. It was forced liquidation across the entire commodity complex. Crude oil, copper, Bloomberg Commodity Index, everything dropped in sync. Why? Because institutions were raising cash ahead of a bond market that started flashing illiquidity. In early April, the 10-year Treasury yield spiked, and suddenly risk managers were telling PMs to degross. That hit commodities hard, and silver took the brunt. But what followed next is more telling. Gold held, barely flinched. Why? Because gold is now being treated like a reserve asset again. That's the tell. And now silver is rejoining gold. That's the next leg. I can't emphasize this enough. If silver clears $34.90 to $35 and confirms that move on weekly momentum, it will unleash institutional FOMO, fear of missing out, in a way the retail investor has never experienced. And the same PMs who just cut risk will suddenly be overweight silver, and miners because there's simply no other sector giving clear breakout signals in a weakening macro environment. That brings us to gold miners. Let me be blunt. Gold miners have been pathetic for over a decade. They underperformed during gold's run from $1,200 to $2,000. They lagged again as gold took out $2,100, $2,200, $2,300. But here's the thing. Miners are still leveraged to gold, and they're now incredibly undervalued based on free cash flow, reserves, and replacement costs. And momentum? Well, momentum has begun to flip. If you look at the Gold Bugs Index, HUI, you'll see it trying to break out of a 12-year base. You heard that right, 12 years. That base has been retested, failed, retested again. But now we're seeing multiple closes above the momentum downtrend line dating back to 2012. The same signal showed up in 2002 before the miners went 10 times in 5 years. What's different now? They're lean. They're not over-leveraged like in 2011. They've cut exploration budgets, focused on cash flow, and yet their equities are still being ignored by major money managers. That's going to change, violently, when silver and gold blow out together. Because suddenly, miners will offer the only levered play left for funds that want exposure to hard assets without holding physical metal. And when you add in the short positioning on GDX and GDXJ, you've got the makings of a bona fide squeeze. Now let's talk about bonds. People ask, where's the crisis? It's here. The T-bond market is broken. When you see yields go from 3.8% to 4.4% in a week, and the bond price collapses with the S&P 500, that's not a rotation. That's credit market dysfunction, the kind that usually precedes a central bank panic. But here's the difference in 2025 versus 2008 or 2020. Back then, the Fed had credibility. They could slash rates, launch QE, and buy time. Not anymore. They're out of credibility. They raised rates into a bubble, inflated asset prices beyond belief, and now every attempt to backpedal only accelerates the decline in confidence. That's why the dollar index is cracking. That's why foreign central banks, who were net sellers of treasuries in 2023, are now quietly replacing those treasuries with gold. The data is clear. The IMF and World Gold Council may not shout it from the rooftops, but central bank gold purchases hit record highs in 2022, 2023, and will likely break those records again in 2025. And yet, mainstream media is silent. Why? Because they don't understand the mechanics. Or maybe they do, and they'd rather you stay in passive index funds until the bottom falls out. Now let's zoom out. What we're witnessing is not a market event. It's a monetary regime shift. In 1971, Nixon closed the gold window. In 1976, gold bottomed. By 1980, the dollar had been cut in half, and gold had gone up 8 times. In 2001, the dot-com collapse began a similar chain of events. 9/11, Greenspan cuts, housing bubble, gold rips to $1,900. Here in 2025, we've got the biggest fiscal deficits in history, global debt at $315 trillion, de-dollarization from BRICS, U.S. bond market seizures, record central bank gold buying, and a stock market perched above a cliff at 4,800. And gold has only gone up 3.4 times from its low? That's nothing. The structural pressures are just getting started. The final phase of every precious metals bull market is vertical, and vertical doesn't mean 10% a year. It means doubling in months. And when silver breaks that $35 level, it's going to run, not because of supply-demand fundamentals, though those are bullish, but because capital is scared and there's nowhere else to go. T-bonds are broken, tech is broken, private equity is a ticking time bomb, and even real estate is no longer a store of value. It's become illiquid. What's left? Gold, silver, and miners. That's the full rotation. And here's the craziest part. The central banks haven't even started panicking yet. They've only woken up. The panic will come when the dollar starts to accelerate lower, when inflation prints reaccelerate, and when the next Fed meeting pivots fully dovish. That's when the throttle goes full open. That's when momentum gets overwhelmed by flow. And I promise you, when that happens, silver will not be under $40. Gold will not be under $4,000. And GDX? It'll be trading in numbers no one's even modeled yet. We're not there yet, but we're close. And this current setup, it's your final boarding call. Watch momentum. Watch the breakout levels. And when silver clears $35 with authority, you'll know. This was the launch point. Don't be the one chasing after the fact. Be the one who understood the structure before the world finally woke up.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.